You know what's fascinating about market squeezes? They don't announce themselves with press releases or official statements. They build quietly in the shadows, layer by layer, until suddenly everyone realizes the game has fundamentally changed. And right now, something extraordinary is happening in the silver market that most people are completely missing. Let me paint you a picture of what's unfolding. Silver just hit a fresh record high, touching levels we haven't seen in decades. But here's what makes this different from every other rally you've watched come and go. This isn't speculation driving prices. This isn't retail investors piling in on hype. This is something far more structural, far more permanent, and far more explosive. We're looking at the fifth consecutive year of structural market deficits. Think about what that means for a moment. 5 straight years where global demand has exceeded supply. 5 years of inventory drawdowns. 5 years of the market consuming more silver than miners can pull out of the ground. And the gap isn't closing, it's widening. The numbers tell a story that should make every investor sit up and pay attention. Global silver demand is running at over 1 billion ounces annually. Industrial applications alone are consuming nearly 60% of all silver produced. And here's the kicker: that industrial demand isn't discretionary. It's not something companies can just decide to cut back on when prices rise. Solar panels need silver. Electric vehicles need silver. 5G infrastructure needs silver. The entire green energy transition that governments worldwide have committed trillions of dollars to, it runs on silver. But let's dig deeper into what's really happening beneath the surface, because this is where the story gets truly compelling. The silver market has always operated in this strange dual nature. It's both a precious metal and an industrial commodity. Gold's wealthy, sophisticated older brother that gets all the attention from central banks and wealth managers. Silver's the scrappy younger sibling that actually does the heavy lifting in the real economy. And that dual nature is creating a perfect storm right now. On one side, you've got industrial demand that's absolutely exploding. Photovoltaic solar installations are consuming silver at unprecedented rates. Each solar panel requires about 20 grams of silver, and the world is installing solar capacity at a pace that would have seemed impossible just a few years ago. Wind turbines, electric vehicle charging infrastructure, advanced electronics, they all need silver's unique properties. It's the most conductive metal on Earth. You can't just substitute it with something cheaper when the applications demand that level of performance. On the other side, you've got investment demand that's starting to wake up. For years, silver lived in gold's shadow. Investors would buy gold for wealth preservation and largely ignore silver. But something's shifting. People are starting to understand that silver might actually be the more explosive opportunity. The gold-to-silver ratio has been historically out of whack, and smart money is noticing. Now here's where this gets really interesting. Let's talk about supply, because this is where the squeeze mechanics really come into play. Silver isn't like other commodities where you can just ramp up production when prices rise. About 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. That means silver supply is largely dependent on the economics of those base metals, not silver itself. Think about the implications of that for a moment. Even if silver prices double or triple, miners can't just decide to produce more silver. They're mining for copper or zinc, and the silver comes along for the ride. The primary silver mines that do exist, they're facing the same challenges every mining operation faces: rising costs, declining ore grades, permitting delays, and years-long development timelines. You can't just flip a switch and bring new supply online. Meanwhile, above-ground inventories are being drained. The COMEX warehouses, where much of the world's tradable silver sites, have seen significant drawdowns. The London Bullion Market Association vaults are tightening, and here's what most people don't understand about these inventories. A huge portion of what's sitting in those warehouses isn't actually available for sale. It's already owned, already allocated, just being stored there. The amount of truly available, unencumbered silver is far smaller than the headline numbers suggest. Let me tell you about something that happened that perfectly illustrates how tight this market has become. There was a major industrial manufacturer, one of the big players in the electronics space, that went to secure their silver supply for the coming year. They'd been buying silver the same way for decades, just calling up their usual suppliers and placing orders. Except this time, they couldn't get the quantities they needed at anywhere near the prices they expected. Their suppliers were telling them the physical metal simply wasn't available in the volumes required. They ended up having to pay significant premiums and lock in long-term contracts at prices that shocked their procurement team. And that's happening across industries. The physical silver market is getting tight in a way that the paper price doesn't fully reflect yet. See, there's this massive disconnect between the paper silver market, the futures contracts and derivatives that trade on exchanges, and the physical silver market where actual metal changes hands. The paper market is enormous, with trading volumes that dwarf the actual physical supply. But when push comes to shove, when someone actually wants to take delivery of physical metal, that's when you discover how much real silver is actually available. This is creating what market veterans call a squeeze, a situation where demand for physical delivery exceeds the available supply, forcing prices dramatically higher. And the setup for this squeeze has been building for years. Every structural deficit adds pressure. Every industrial application that becomes dependent on silver adds pressure. Every investor who decides to hold physical metal instead of paper contracts adds pressure. Let's talk about what happened in previous silver squeezes, because history has a way of rhyming even if it doesn't repeat exactly. Back in the late 70s, the Hunt brothers tried to corner the silver market. They accumulated massive positions, taking physical delivery, and silver went from around $5 an ounce to over $50 in just a couple of years. Now, that ended badly for the Hunts when regulators changed the rules mid-game. But here's what's different now. This isn't a manipulation or a corner. This is fundamental supply and demand dynamics playing out in real time. Or look at what happened in early 2021. A group of retail investors on social media started talking about a silver squeeze, trying to replicate what happened with certain stocks. Silver spiked, premiums on physical coins and bars went through the roof, and dealers couldn't keep inventory in stock. But that was mostly a retail-driven phenomenon that faded when the momentum traders moved on to the next thing. What's happening now is different because it's not driven by social media hype. It's driven by structural deficits and industrial demand that isn't going away. The solar industry alone is projected to consume increasingly massive amounts of silver over the coming years. And that's just one sector. Electric vehicles are becoming mainstream, and each EV uses significantly more silver than a traditional car. The charging infrastructure to support millions of EVs. That's silver-intensive too. 5G networks rolling out globally? Silver. Advanced medical equipment? Silver. Water purification systems? Silver. And here's something most people don't consider. Silver is consumed in these applications. Unlike gold, which mostly sits in vaults and jewelry and can be recycled, silver gets used up. It's in tiny amounts spread across millions of devices and applications where it's not economically viable to recover it. Every year, a significant portion of silver production is essentially removed from the available supply forever. Now, I want to take a quick moment here because this is relevant for a lot of people watching. If you're sitting on retirement accounts, maybe you've got $100,000 or more in a 401k or IRA. There's a free guide in the description about how gold IRAs work. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if that's something you're thinking about. But let me get back to what's happening in this market right now. The institutional players are starting to position themselves. Central banks, which have been massive gold buyers, are beginning to look at silver differently. They're seeing the same supply-demand dynamics everyone else is seeing. Hedge funds and commodity trading advisors are building positions. The smart money isn't waiting for confirmation. They're accumulating while most people are still trying to figure out what's happening. And here's where the squeeze mechanics really accelerate. As prices rise, it attracts attention. More investors want exposure. But unlike stocks, where companies can issue more shares, or bonds, where governments can print more debt, you can't just create more physical silver. The supply is what it is, so increased demand has nowhere to go except into higher prices. This creates a feedback loop. Higher prices attract more attention, which brings more demand, which pushes prices higher, which attracts even more attention. And in a market that's already in structural deficit, where inventories are already tight, where industrial demand is already consuming the majority of supply, this feedback loop can become explosive. Let me give you a sense of scale here. The entire above-ground silver inventory, all the silver in vaults, all the silver in coins and bars held by investors, all the silver sitting in warehouses, it's estimated at around 2 to 3 billion ounces. That sounds like a lot until you realize that annual demand is over 1 billion ounces. And remember, much of that above-ground inventory isn't for sale. It's owned by investors who are holding long-term, or it's industrial inventory that companies need for production. The amount of silver that's actually available for new buyers, it's a fraction of what people think. And when you've got industrial users who need silver to keep their factories running, competing with investors who want silver for wealth preservation, competing with speculators who see a squeeze developing, you've got a recipe for a price explosion. Now let's talk about the paper market, because this is where things get really interesting. The futures market for silver is massive. The notional value of silver futures contracts traded dwarfs the value of physical silver that actually exists. This works fine in normal times when most contracts are just rolled forward or cash settled. But what happens when a significant number of contract holders decide they want physical delivery? This is what people mean when they talk about a squeeze in the precious metals markets. If enough futures contract holders stand for delivery, meaning they actually want the physical metal instead of just cash settlement, the exchanges and banks that sold those contracts have to deliver. And if they can't deliver because the physical metal isn't available, they have to buy it on the open market at whatever price they can get it. That's when prices can gap dramatically higher in very short periods. There are signs this might be starting to happen. Delivery notices on COMEX have been elevated. Premiums for physical silver over the paper price have been widening. Dealers are reporting difficulty sourcing large quantities. These are the early warning signs that the paper and physical markets are starting to disconnect. And once that disconnect becomes obvious to the broader market, once people realize that paper contracts might not be backed by actual metal, that's when the real rush begins. Because at that point, everyone holding paper exposure is going to want physical metal, and there simply isn't enough to go around. Let's think about this from a different angle. What would it take to actually resolve these structural deficits? You'd need either demand to fall significantly or supply to increase dramatically. But demand is being driven by long-term trends that aren't reversible. The green energy transition, electrification, technological advancement. Governments have committed to these paths. Industries have invested billions in infrastructure that depends on these technologies. That demand isn't going away. And supply, we've already talked about why supply can't respond quickly. But there's another factor. At current prices, many silver mining operations are barely profitable. The cost of production has been rising due to inflation, energy costs, labor costs, and declining ore grades. If anything, we might see supply decrease if prices don't rise enough to justify continued production at marginal mines. So you've got inelastic demand meeting constrained supply in a market that's already in deficit. And the only way that equation balances is through significantly higher prices, not a little higher. We're talking about the kind of price moves that create generational wealth for people positioned correctly. Think about what silver at $100 an ounce would mean. That's less than a tripling from current levels, and it would still leave silver historically cheap relative to gold. The gold to silver ratio would still be above 20 to 1, when historically it's averaged closer to 15 to 1 and has gone as low as 10 to 1 during silver bull markets. There's nothing fundamentally crazy about silver at $100. In fact, given the supply-demand dynamics, it might be conservative. But here's what most people miss. The move from here to there won't be smooth. It'll be volatile, with sharp moves up and equally sharp corrections. There will be moments when it feels like the rally is over, when the mainstream media declares the top is in, when weak hands get shaken out. That's how bull markets work, especially in commodities. They climb a wall of worry, taking 2 steps forward and 1 step back, until suddenly they're at levels that seemed impossible at the start. The key is understanding the difference between volatility and the underlying trend. The trend is being driven by fundamentals that aren't changing: structural deficits, industrial demand, constrained supply. The volatility is just noise, the market's way of transferring wealth from impatient hands to patient ones. And here's something else to consider: silver's role in the broader financial system. For thousands of years, silver was money. It was the medium of exchange for ordinary commerce, while gold was reserved for large transactions and wealth storage. That monetary history never really went away, it just got papered over by fiat currencies. But when people lose faith in paper money, when inflation erodes purchasing power, when currency crises emerge, they remember that silver is real money. We're seeing signs of this monetary demand returning. Coin sales from government mints have been strong. Retail investors are buying physical silver in forms they can hold. There's a growing awareness that in a world of unlimited money printing and ballooning government debts, hard assets with limited supply are the place to be. And silver has advantages over gold for many investors. It's more affordable. You can buy meaningful amounts without needing tens of thousands of dollars. It's more divisible. If you ever needed to use it for transactions, silver coins are more practical than gold. And it has that industrial demand component that gold lacks, giving it multiple drivers for price appreciation. Let me paint a picture of what this could look like as it unfolds. First, you'll see continued strength in the price, with silver grinding higher and making new highs. The mainstream financial media will start paying attention, running stories about the silver rally. That brings in the first wave of new investors, people who follow financial news and want to participate in what's working. As prices continue higher and the story becomes more widely known, you'll get the second wave, Retail investors who don't follow markets closely but hear about silver from friends or see it trending on social media. This is when premiums on physical products really start to spike, when dealers struggle to keep inventory, when wait times for delivery extend from days to weeks. Then comes the institutional wave. Hedge funds, commodity funds, pension funds. They move slowly, but when they move size. And they're not buying a few coins or bars. They're buying thousands of contracts, millions of ounces. This is when the paper market really starts to strain, when the disconnect between paper and physical becomes undeniable. Finally, you get the panic phase. This is when people who ignored silver, who thought they had time, who were waiting for a pullback, suddenly realize the train is leaving the station. This is when prices can move in ways that seem irrational, when silver can gain 10 or 20% in a single day, when the squeeze reaches its climax. Now, I'm not saying this all happens tomorrow or next week. Market moves like this take time to develop, but the foundation is being laid right now. Every month of structural deficit adds to the pressure. Every new solar installation, every new EV, every new 5G tower adds to the demand. Every ounce that gets consumed in industrial applications is one less ounce available for investors. And here's the thing about squeezes. By the time everyone recognizes what's happening, it's too late to get positioned at reasonable prices. The people who profit the most are the ones who understand the setup before it becomes obvious, who accumulate before the crowd arrives, who have the patience to hold through the volatility. Think about the investors who bought silver in the single digits and held through the rally to $50 in the late 70s, or the ones who accumulated in the low teens and rode it to nearly 50 again in 2011. They didn't time the exact bottom, they didn't catch every move perfectly. They just understood the fundamental story and positioned themselves before the crowd figured it out. That's the opportunity we're looking at right now. The fundamentals are arguably stronger than they've ever been. The supply-demand deficit is real and growing. The industrial applications are expanding, not contracting. The monetary environment with negative real interest rates and currency debasement favors hard assets, and the technical setup shows a market breaking out to new highs with strong momentum. But beyond all the analysis and data and charts, there's a simpler way to think about this. Silver is a finite resource that's being consumed faster than it's being produced, in a world that's becoming more dependent on it, at a time when people are losing faith in paper assets. That's not a complicated thesis. It's supply and demand at its most basic level. The question isn't whether silver prices are going higher, the math says they have to. The question is whether you're going to be positioned before the move becomes obvious to everyone else. Because once it's obvious, once the mainstream media is running daily stories about the silver squeeze, once your neighbors are talking about buying silver, the easy money has already been made. This is one of those moments in markets that doesn't come along often, where the fundamentals are screaming one thing, but the price hasn't fully reflected it yet, where patient, informed investors can position themselves ahead of a major move, where understanding the story before the crowd gives you a massive advantage. The silver squeeze isn't coming. It's already here. It's been building for 5 years of structural deficits. It's been building through the expansion of industrial applications that can't function without silver. It's been building as above-ground inventories get drawn down and the gap between paper and physical widens. And now it's starting to go viral as more people wake up to what's happening. The smart money isn't waiting for confirmation. They're not waiting for silver to hit some arbitrary price level before they believe the story. They're accumulating now while most people are still trying to figure out what's happening, while the opportunity is still available at reasonable prices. Because here's what history teaches us about commodity squeezes. They move faster and further than anyone expects. The people who wait for certainty, who want to see more proof, who need the mainstream media to validate the story before they act, they end up buying at much higher prices or missing the move entirely. This is your moment to decide. Are you going to be ahead of this? Or are you going to watch it unfold and wish you'd acted when you had the chance? The setup is there. The fundamentals are there. The squeeze is building. What happens next is up to you.